All right, so starters, I want to talk about some accounting principles. And these accounting principles are going to stay true whether you're in the US or abroad. There's three things that all accountants, in terms of accounting ethics, should always follow and keep in mind. All right, and we've talked about this maybe just briefly on the surface, but never really talked about it in detail. And so that's what I want to make sure that these concepts or these principles kind of pass on to you and they stick with you. And so one of them is confidentiality. So when you talk about accounting ethics, confidentiality is one that's huge. And confidentiality is keeping financial information private. So as a medical provider, like thinking about a different industry, they have laws and regulations about keeping patients' information private, right? And so you guys are probably familiar with or heard the phrase HIPAA before, right? And so with accounting, and now we're going back to this industry, this financial industry, with accounting, there's this ethic, there's this code that you want to follow, and that one of those codes that you want to follow is this idea, this ethic of confidentiality. Because as an accountant, you're going to have access to individuals' private financial information, including their birthday, their social security number, you have their address, right? And you know how much they make, how much they pay in taxes. You get a lot of information available at your fingertips. And so one of the accounting ethics, even if there's not a formal law about this specific piece of information that you're privy to, you want to follow this code of ethics. And this is an overarching code of ethics. So while you might work for an institution that has a employee handbook that tells you this is what you're allowed to do, this is what you're not allowed to do, yes, you do need to follow that code of ethic within that company, but there's a higher calling in the industry of accounting that you have to answer to. Just like people in the medical field, right? They don't just follow the code of ethics for the hospital that they work at. They follow this code of ethics for the whole industry at large. So if there's somebody on a plane that needs medical attention and they have the ability to provide some medical assistance while they're on the plane, even though they're not on the clock, they're not at the hospital that they work at, there's no rule in their employee handbook at the hospital that they work at that they have to do this, but they're answering to a higher calling or a higher rule, which is their industry, right? In the same way for accountants, we're called to a higher standard than just what our just what our company calls us to, or our own personal ethic hopefully is as good or better than that, but we want to make sure that we maintain confidentiality when we're dealing with information that we're privy to that other people wouldn't be privy to. And that means even talking about things in private amongst your friends or your family, you still don't want to bring confidential information that you've learned about or you know about at work into conversations at the dinner table or amongst friends. You want to maintain confidentiality, and that is keeping financial information private, all right? So if you know somebody just lost their job, hey, even before it becomes public information, maybe the person hasn't shared it on their Facebook page yet, you have a duty as an accountant to keep that information confidential. All right, the second thing in terms of a kind of a code of ethics is this idea of conflict of interest. As an accountant, you want to make sure that you avoid putting yourself in a position where you're going to have a conflict of interest. And so that means avoiding situations where your personal interest interferes with your professional ethics. All right, so conflict of interest is avoiding situations where your personal interest interferes with your professional duties or your professional job, all right? So for example, if you are working with a firm and they assign you an audit for a company that you own stock in, right? Or maybe not a company that you own stock in, but maybe your parents own stock in that company and you're aware of it, in that moment, even if it is for you a good move professionally to take on this audit and get this experience, you have to make the call. Nobody's going to call you on it, right? Especially if it's your parents. There's nothing on paper that ties you directly to owning this stock, but you know it. It's a conflict of interest because you'll have a personal interest to not find something on that financial audit because you want that company stock to keep going. If you find something on that financial audit, then you're starting to open up potentially a bag of worms that could, bring the stock price down once news gets out of a bad audit or whatever it might be. And so you want to remove yourself from that situation. That's kind of like a real basic example. There's definitely going to be situations in life where it's a lot more gray than that. It's not necessarily going to be black and white. Okay, and so you want to remove yourself from situations where there could even be a potential for conflict of interest. All right, so it doesn't necessarily even have to be drawn out, hey, yes, this is a conflict of interest. If it looks like a conflict of interest, or it could look like a conflict of interest, you want to avoid those situations as an accountant. All right, and the final thing is integrity. All right, so when you're talking about ethics in accounting, you got confidentiality, keeping information private, conflict of interest, avoiding situations where your personal interests conflict with your professional duties, and then finally integrity. And integrity kind of wraps this all up together. And integrity is being honest and doing the right thing, even if it costs you something, but then also even if nobody else is going to catch you or is paying attention or nobody else is looking, it's doing the right thing even when no one is watching because it's the right thing to do. And so if you remember the first or second week of this class, I said that this entire industry is based on one thing, and that's believability. If we can't trust accountants, right, if what they provide us is not believable, if it's not accurate, if it's not trustworthy, if it's not on time, there's no point of us having this industry at all. And so the whole industry of accounting is banking on this idea of believability. And in order for us to maintain our believability, we have to be people of integrity, and that means doing the right thing no matter what, no matter who's watching, no matter what, if it has personal cost to us, we need to make sure that we're doing the right thing. All right, so the next thing that I want to talk about today, which is going to take a little bit longer potentially than I want it to, but we need to get through it, is the accounting cycle. All right, and so the accounting cycle, and I will give you guys a handout directly from the textbook that kind of summarizes the accounting cycle and puts a graphic to it, or I'll post it on Canvas for you as well. But the accounting cycle is something that you need to be familiar with and kind of have a general idea of going into the NOCTI exam. All right, so if you remember, step one of the accounting cycle is analyzing source documents, okay, or analyzing transactions. And so when you talk about the accounting cycle, the first step is to analyze your source documents or your transactions that you see. And when we talk about source documents, it's a receipt, it's an invoice or a bill. It's basically our proof that whatever that we're putting into the accounting system has backup to it. We're not making it up, it's not fictitious, it's not fraudulent, it's a legitimate bill that belongs to the business that needs to be in the accounting system, right? So once a transaction happens, whether it's a sale or a purchase, you're usually going to have some sort of source document that goes with that transaction. And when we analyze this document, we're going to figure out which accounts are affected, all right? And once we understand which accounts are affected, then we're going to make the entry that shows one account being debited, one account being credited, and that's because we use what's called double entry accounting. And so double entry accounting means that every transaction has at least two accounts that are affected, and that our debits must equal our credits. And this is important because it helps keep the accounting equation in balance. And so remember the accounting equation, assets equals liabilities plus equity. And so in order to keep that accounting equation in balance and create a reliable audit trail, we have double entry accounting, which means at least two accounts are affected with each journal entry. And so for every debit, there has to be an equal credit. And that is the basic rule of double entry accounting. And so remember the accounting equation, assets equals liabilities plus equity, and that has to stay in balance. So every transaction that happens, it's got to make sure that it maintains the integrity of the accounting equation and make sure that it stays in balance. And so when a company makes a transaction, it affects one or more parts of the equation. And so for example, if you buy supplies on account, supplies is classified as an asset account, so assets would be increasing. If you bought it on account, that means that you owe somebody money. So then liabilities or accounts payable would be increasing. And so both sides of the equation would be increasing by the same amount. That would help the accounting equation stay in balance. We would be following double entry accounting. All right, so we could go through some more examples there, but I think you guys have a basic understanding of the accounting equation, how it works, and how those transactions have to make sure that debits equal credits. So then your second step is to journalize the transaction. So once you've analyzed your source documents and you understand the debit and credit part of that transaction, then the next step is to journalize that transaction. And that transaction could be journalized in a number of different journals. The first one that we started out with was the general journal, and we kind of made that our catch-all at the beginning of the school year. But then as the school year progressed, we introduced special journals, and those special journals reduced the amount of time it took us to journalize our entries, and it also helped minimize the likelihood that we would make an error when we were entering those transactions. And so in the second step, you're going to journalize the transaction. And when you journalize the transaction, remember you have that source document column, and that source document column helps you create an audit trail and shows that, hey, yes, we have a source document for this entry, and we analyzed it before we went in to make this journal entry. And so then your third step after you've journalized the transaction is to post the transaction to the ledger. And remember, every account has its own ledger, and posting to the ledger also creates or continues to create this audit trail, right? And so each journal entry gets posted to its corresponding ledger account, and then we have the post, what is that? So what's the next? Is it postdoc column that shows, hey, this is getting posted to this account, and then if you go to that account and you look at that account, there's a column in there that says, hey, this is being posted from, and it points back to the journal that's being posted from. So if it's general journal, page 13, it would be G13, and so on, depending on the company and how they have their things set up. And so after you've analyzed your source documents, you've journalized your transactions, you've posted to the ledger, then in step 4, you're ready to prepare your worksheet and your trial balance. So you prepare your worksheet and your trial balance. And remember, the worksheet is not a permanent document, right? The worksheet was just basically the accountant's scratch paper. And so that's where you started out trying to figure out, okay, hey, do our debits equal our credits on our trial balance? And the primary purpose of the trial balance, those first 2 columns on the worksheet, is to make sure that your debits equal your credits. And so what is the purpose of the trial balance? The purpose of the trial balance is to make sure your debits equal your credits. And if they don't, that means that there was some error somewhere in the journalizing of transactions and posting it to the ledger. You need to go back and check them out to make sure that every transaction is journalized and posted correctly so that debits equal credits on your trial balance. All right, once you've prepared your trial balance on your worksheet, then you continue on your worksheet, which is, remember, just a temporary piece of scratch paper that you're working on to figure out what adjusting entries need to be made to update your balances to where they ought to be. And so you're going to make your adjusting journal entries. And this is to comply with what's called accrual accounting. And remember, accrual accounting is required by GAAP And GAAP is the generally accepted accounting principles, right? And to comply with GAAP, we use accrual accounting. And accrual accounting is recording revenue when it's earned and expenses when they're incurred, not just when cash trades hands, right? And so revenue when it's earned and expenses when they're incurred, that's accrual accounting. We looked at this in chapter 21, and you dealt with some accrual entries and some deferral entries, right? And so it's important to record transactions when they occurred, not just when cash changes hands, because you want to get a more accurate representation of what's happening with the company, right? If the company is making sales, you want that to be reflected. If the company is purchasing things on credit, you want that to be reflected, and you want it to be reflected in the period in which it happened, right? And that goes with the matching principle of accounting, where you want to match revenue and expenses in the period that they occurred, even when cash is not necessarily changing hands in that same period. And so the purpose of adjusting entries is to make sure that we're following GAAP and that these expenses and revenue are posted and recorded in the correct accounting period. All right, and so remember some of the examples was prepaid insurance, right? We need to adjust that asset. Supplies, we need to adjust that asset. Interest, revenue, interest, expense. Those are things that could be accrued but not necessarily paid or received yet. And so we wanted to take care of that during our adjusting journal entries, right? And so an accrued expense would be something that, hey, like let's say payroll, for an example, is a great accrued expense. Our employees have worked. They have earned the money that we need to pay them. But hey, we don't pay till the 15th of the month. So they've worked all of December, but we're not going to pay them until the 15th of January, right? So we want to make sure that that amount they earned in December is recorded in December. That would be an accrued salary expense, and then we would end up actually paying it in the next period. But we want that expense to be tied to December, not to January when we actually end up paying it. All right, so once we've made our adjusting journal entries, the way that it's going to affect our financial statements is going to make sure that our income and our balance sheet actually shows what actually happened during that period of time. And some other examples would be like prepaid rent, right? So prepaid rent is something that you pay in advance, and then as each month passes, you want to reduce the amount of prepaid rent you have that you would be considered as an asset or something that's owed to you. And then once you've used it up, you want to expense it and reduce it, just like you would prepaid insurance. All right, so once you've made your adjusting journal entries, remember on that worksheet, you got your trial balance, you got your adjusted journal entries, and then remember it pushes out to those last two sets of columns into the income statement and into the balance sheet, right? And so now, with that worksheet as your scratch paper, you're ready for step 6, which is to prepare your financial statements. All right, and in this last chapter, we added an additional financial statement, and that financial statement that we added in chapter 22 is actually the only one that follows cash basis accounting instead of accrual accounting. The other ones all follow accrual accounting. And so when we're preparing our financial statements, primarily, at the very least, the two things that we prepare is the income statement and the balance sheet. And remember, the income statement captures all of our temporary accounts, which is our revenue and expenses. And then our balance sheet carries all of our permanent accounts, which is our assets, our liabilities, and our equity accounts. And then the other additional financial statements that you could also produce are your cash flow statement, which we talked about recently. You could also produce your statement of stockholders' equity, which zooms into the equity section of your balance sheet. And I think that's the only ones that are coming to mind right now. So I think altogether we had 4 different financial statements that we've prepared: income statement, balance sheet, statement of cash flows, and statement of stockholders' equity. All right, and so given that, if you're given one of two things on, like, for example, the accounting equation, right? If you know what assets are and you know what liabilities are, can you solve for equity? Or, for example, if you're given some information on the income statement and you know what revenue is and you know what expenses are, can you solve for net income, right? Do you know what the formula is to solve for net income, right? Remember, net income is your gross profit minus your operating expenses. How do you get to your gross profit, though? Remember, your gross profit is going to be your revenue or your sales minus your cost of goods sold. And then once you have your gross profit, you can subtract your operating expenses and get to your net income. All right, and then after you've prepared your financial statements, your step 7 is to close your temporary accounts. And so you're going to have your closing journal entries, and your closing journal entries are going to set all of your temporary accounts, the ones that are on your income statement, your revenue and your expense accounts, they're going to set them back to 0. And so there were primarily 4 different closing entries that you need to make, right? So when you talk about closing entries, there were 4 closing entries that you need to make. One, you needed to set all your revenue accounts back to 0, right? So you're going to close revenue accounts to income summary and set them back to 0. And so I say revenue accounts, but you could just basically say anything that's on your adjusted trial balance, that's income summary and below, that's on the credit side. So closing all your credit balances to income summary, setting them to 0. Then you want to close your expense accounts, or you could say all of your accounts with debit balances, you want to set them to 0. You're going to close them to income summary. And then you would close income summary and set it to 0. So you would close income summary to your retained earnings account. And this is obviously for a corporation. If you were dealing with a sole proprietorship, in this step, you would be closing the drawing account to the owner's equity account. Is that right? Or you would be closing net income or net loss to the owner's capital account. All right. And then step 4, you want to close dividends to retained earnings. So once you're done with your closing entries, your next step is your post-closing trial balance. And your post-closing trial balance is just going to make sure that all of your permanent accounts are recorded correctly and that your debits still equal your credits. Make sure that the accounting equation is still in balance. So you're going to prepare your post-closing trial balance, which is basically just going to capture all of your permanent accounts, so your assets, your liabilities, and your equity with its updated amount after you've made your closing journal entries. And the purpose of the post-closing trial balance is kind of the same as the trial balance. You want to make sure your debits equal your credits. After you've done all your work, you want to make sure that this accounting equation is still in balance. All right? And just some quick final last steps. These are just, I know this is like drinking from a fire hose. I'm just throwing a lot of stuff at you really quickly, but just a couple of more things here, and then we're done. Probably less than 5 more minutes. Remember, your depreciation methods. LIFO, you have FIFO, you have the weighted average, you have LCM, lower of cost or market. I feel like there's one more that I'm missing out and I can't remember what it is. But remember that LIFO is last in, first out. And so when you see LIFO, you should be thinking about that pile of sand. right? Last in, first out. That means that the first in is still here. So the earliest inventory that you have, your beginning inventory, is still here. All right. FIFO, first in, first out. That means that think about milk in a grocery store refrigerator, right? The first inventory that came in, that's the first inventory that's gone out. So that means that the most recent inventory that you purchased or brought into your business is the inventory that's still here. The weighted average method takes an average of all of the inventory that you have and then calculates your ending inventory based on an average cost of all of your inventory. And then the lower of cost or market, and this is what IFRS requires you to use, that's International Financial Reporting Standards, is the lowest between the type of inventory valuation method that you use, so whichever one it is, and what the current market price of that inventory would be, or current market cost of that inventory would be. Whichever one is lower, that's how you would value your ending inventory. So LCM is actually the most conservative approach to valuing your inventory to make sure that you're not overstating your assets, in case you're carrying dead weight inventory. All right, I think that's it. So that's it for today. And so tomorrow and the next couple of days, we'll have a couple more of these. And so what I want you to do now with the time that you have left in class is